Welcome to the Deep Dive. Today we're tackling a sector that's, well, literally foundational industrial and construction equipment rental,
That's right.
and we're focusing on the giant in the room, United Rentals, or URI. If you've ever driven past a huge construction site and wondered how all that massive equipment gets there and stays running,
Uh-huh.
and how the company providing it operates with, high-tech precision, this is the deep dive for you.
Absolutely. We're working from their latest Q3 2025 investor presentation and SEC filings today. And our goal really is to get under the hood of a true market leader.
Right.
We want to see how they maintain that top spot in North America, what drives their, frankly, impressive margins, and, how technology helps them navigate what's fundamentally a pretty cyclical business.
Okay, let's get started. And maybe just to set the scene, let's talk scale, because the numbers are kind of mind-boggling.
They really are.
As of the end of September 2025, we're talking about, nearly 7,740 branches globally, almost 28,000 employees?
Yeah.
But the fleet size, that's the jaw dropper. Roughly $23 billion worth of equipment, and that's measured using OEC, original equipment, at cost.
And using OEC is key, right? It gives you a solid baseline of their investment, sort of stripping out short-term market noise. But that sheer scale, that $23 billion fleet and the network to support it,
Yeah.
that's a massive competitive barrier.
A moat, essentially.
Exactly. It makes it incredibly hard for smaller regional players to compete outside of very specific niches. They just can't match the breadth of equipment or the geographic coverage.
And this scale didn't just appear. It exists because the way construction firms work has fundamentally changed, hasn't it?
Yeah.
Why rent this incredibly expensive gear instead of buying it?
Well, the sources lay out 5 main reasons customers prefer renting. First, conserving capital. Big one. Turns a huge upfront cost into a predictable operating expense.
Okay.
Then there's availability.
Yeah.
Getting the exact piece of equipment needed for a specific job right when you need it. Plus, reliability. Less downtime. URI handles the maintenance, the
It
logistics.
takes that headache away.
Completely.
Yeah.
And finally, it's risk management. You avoid worries about the equipment becoming obsolete or dealing with changing regulations around emissions or safety. URI handles that.
It's quite a value proposition. Now, this didn't happen overnight. You mentioned their strategy has evolved. Can you walk us through those phases?
Sure. They really started back in 1997 through about 2008 with a clear goal. Just become the market leader, a lot of growth tied to the housing boom then.
Right.
Then came the transform the core phase, roughly 2009 to 2013. That was heavily focused on integrating RSC, a huge acquisition that really helped them streamline their national accounts.
Ah, the RSC deal.
I remember that.
Yeah, it was pivotal. And then from 2014 to 2022, it was all about growing the core. That's when they did something like 250 acquisitions.
Wow, 250.
Yeah, a lot of them smaller, strategic tuck-ins, really focused on building out their specialty rental offerings, creating that one-stop shop customers wanted. Okay, so that brings us more or less to today. Their current strategy seems built on these competitive pillars they talk about. Scale is obviously one. What are the others?
They list 5. Tailored go-to-market models, deep expertise, breadth of solutions, technology, and data and insights. And deep expertise is maybe a good example of how it's more than just renting gear.
How so?
Well, take trench safety. They don't just drop off a trench box. They have experts, certified people who can assess the site, the soil conditions, and actually design a compliant safety plan. They're selling expertise, safety, productivity, not just rental hours.
That's a significant difference. And the results seem to back this up. Their growth is outpacing the general construction market, right?
Massively outpacing it.
Yeah.
That's maybe the clearest sign of this secular shift, from owning equipment to renting it. URI is actively driving that shift.
What are the numbers?
Their compound annual growth rate, CAGR, from 2019 to 2024 was 10%. The overall industry average growth was more like 6.6%.
So more than 1.5 times the industry rate.
Exactly. They're not just riding the wave. They're actively taking share and changing how the industry operates.
Okay, this is where I think it gets really fascinating. Let's drill down into those twin engines you mentioned that seem to be driving this outperformance. Specialty rentals and digital transformation.
Yeah, let's do it.
So specialty first. These aren't your standard bulldozers, right? They serve more complex needs, often regulated, and critically, they come with better margins.
Much better margins. It's a big chunk of the business now. In 2024, specialty was, 33.4% of total revenue, a third of the business?
And growing fast.
Phenomenally fast.
Yeah.
The CAGR for specialty between 2014 and 2024 was over 20%. Compare that to their overall revenue growth in 2024, which was about 7%. You can see where the acceleration is coming from.
So what falls under specialty? Give us some examples.
Things like trench safety solutions, which are highly regulated, power generation and HVAC systems, complex fluid solutions, pumps, tanks, filtration, also mobile storage units, and matting solutions for ground protection on sensitive sites. It's sophisticated stuff.
And they didn't just magically develop all this expertise overnight. This ties into M&A, right? Acquisitions.
Absolutely. M&A is a core competency for them. They've used it strategically, not just for scale in general rentals, think RSC or earn, but very specifically to buy into these high-margin specialty areas.
Like who?
Well, they mentioned YakMat for the matting solutions, General Finance for mobile storage, Thompson Pump and Baker Core for fluid solutions. Each acquisition brings specific expertise, customer relationships, and helps them cross-sell across the whole portfolio.
Okay, so strategic M&A fuels specialty growth. Now let's layer on the second engine, technology. How is digital changing the game here?
It's creating value in multiple ways. The adoption rates alone are telling. In 2024, 76% of their total revenue involved their digital tools in some way. That's up from 70% the year before.
76% is huge.
It is. And look at online revenue, up 22% year over year. Online payments up 31%. Customers are clearly embracing these tools.
What are the tools specifically? Is it just an online catalog?
No, it's much more than that. There's the digital marketplace, yes, for checking availability and ordering online. But the real powerhouse is their telematics platform, Total Control.
Total Control. Okay, what does that do?
It's basically an integrated fleet management system for the customer. It tracks equipment location, usage hours, engine diagnostics, fuel levels, everything.
Ah, so it's data for the customer, not just URI.
Exactly. Think about those 8.4 million customer notifications they sent in 2024, up 20% year over year. Some are simple rental reminders, sure, but many are likely alerts generated by Total Control, like, hey, the engine temperature on Excavator 3 is running high, you might want to schedule maintenance. Or, this machine hasn't moved in 48 hours, are you still using it?
I see. So the benefits are pretty direct then. Better uptime because of predictive maintenance?
Yep. Optimized utilization customers see exactly what they're using, where, and for how long, so maybe they don't need that extra machine after all. And improved safety, potentially, by restricting equipment operation to authorized users via PIN codes or badges.
So technology is really pushing them beyond just renting equipment towards being more like a worksite productivity partner.
That's exactly the goal.
All right, let's switch gears a bit and look at the financials, especially the recent Q3 2025 numbers. We know the history is strong, that 10% plus CAGR for revenue and adjusted EBITDA over the 5 years ending 2024. What did the latest quarter look like?
Well, year to date through September 30th, 2025, total revenue hit almost $11.9 billion. Adjusted EBITDA was around $5.4 billion, so still very strong performance.
But the number that always jumps out with URI is the margin.
Right. The adjusted EBITDA margin was 46.7% for the full year 2024. That's really high for this kind of business.
It is 46, almost 47%. In a capital-intensive, cyclical industry like construction, how do they sustain that? What does that margin tell us?
I think it tells us a couple of crucial things. First, the power of scale, again, that massive revenue base, allows for incredible fixed cost absorption. All their overhead, the IT, the admin, the M&A teams, it gets spread so thin across each rental dollar, smaller players just can't match that efficiency.
Makes sense. And the second thing,
It's that mix shift we talked about. Moving more revenue into those higher margin specialty segments, that directly lifts the overall margin profile. Plus, they're constantly focused on operational efficiency lean practices using technology internally. Their target is to consistently generate over 15% return on invested capital.
and they manage the risks pretty well too, like equipment getting old or maintenance costs spiking.
They do. Scale helps, obviously, but also the data from Total Control lets them be smarter about maintenance schedules, when to rotate equipment, and when to sell it into the used market. They have a very sophisticated fleet management operation.
Looking at the balance sheet, it seems quite robust. They flagged $16.2 billion in cumulative free cash flow over the last decade.
Yeah, that's a huge number. It translates to an average free cash flow margin of over 17% for 10 years straight. That shows incredible resilience and cash generation power.
And that cash flow supports their capital strategy. Leverage looks pretty controlled.
Very controlled. As of Q3 2025, their leverage ratio was 1.9x, which is comfortably inside their target range of 1.5x to 2.5x.
Ah,
They have flexibility. You saw that in Q3, actually, with the terminated H&E acquisition.
right. They got a breakup fee.
Yeah, a $64 million breakup fee, which resulted in a net benefit of about $39 million. They're also actively managing their debt costs. Noted that the average rate on their variable debt dropped from 6.4% to 5.4% compared to the prior year. Little optimizations that add up.
And when they have excess cash, it seems they're pretty aggressive about returning it to shareholders.
Definitely. They prioritize organic growth and M&A first, that's clear. But they're disciplined about returning the rest. They boosted their share repurchase program to $2 billion back in July 2025.
And those buybacks have had a real impact over time.
Oh yeah. Since 2012, they estimate repurchases have cut the number of shares outstanding by about 45%. That's significant shareholder value creation. Plus, they're growing the dividend. The quarterly payout in 2025 is $1.79 per share, up 10% from 2024.
Okay, so wrapping this up, what's the big picture here for you, the listener? This story of URI, it's clearly about more than just, renting out heavy machinery.
That's right.
It seems to boil down to maybe 3 core things they do exceptionally well.
Yeah.
Leveraging that almost unbeatable scale, driving that high-margin growth through specialty,
Yep.
and weaving digital technology through everything, not just for their own efficiency, but to fundamentally change the customer relationship.
Couldn't say it better. And the key takeaway, I think, is that while construction is cyclical, URI is doing everything it can to build resilience. Their long-term play isn't just being the biggest rental yard, it's becoming that essential partner for worksite safety, productivity, sustainability. That's a much stickier, higher value proposition.
Which leads to a final thought, doesn't it? Based on that digital integration, the total control platform, the data and insights pillar they talk about, if they're collecting detailed, real-time data from thousands of job sites, knowing exactly which equipment works best where, predicting maintenance needs, identifying bottlenecks, how much further up the value chain can they actually go?
Right. Could they move from just supplying equipment to becoming essentially an outsourced project optimization partner, using their proprietary data to advise customers on how to run the entire job site more efficiently?
And if they do that, what does that mean for smaller competitors who just don't have access to that kind of data-driven insight? It could become another huge competitive advantage, couldn't it?
Potentially, yes. It's definitely something to watch. A space where data could truly transform the industry structure.